Welcome back, everyone, to the Network Marketing Cowboy channel. Today, we're talking about a subject most people avoid, but every wealthy person masters tax strategies. If you're earning money in network marketing and building wealth through real estate, you need to understand how taxes can either make or break your financial future. You've probably heard the quote, "It's not how much you make, it's how much you keep." Well, in today's episode, I'm going to show you how to keep a whole lot more. Again, I'm not a financial advisor, so I should make sure you contact your tax person, your accountant, and all that to do this, talk with this stuff. We have professionals that work for us, so I'm just throwing that disclaimer out there. So what we're going to talk about today, the biggest tax mistakes people make in network marketing and real estate. How to legally reduce your taxes with smart strategies. Deductions, structures, and loopholes you should be using. Why the IRS actually wants you to play this game. Stick with me until the end. I'll give you the simple tax structures I personally use that keeps more of my money in my pocket while staying 100% compliant. Mistake 1. Treating network marketing like a hobby. Many reps don't track their income, expenses, or file correctly. You must treat it like a business to get business deductions. If you're making money, you're a business owner. The IRS expects you to act like one. Mistake 2, not keeping good records. If you don't document it, you can't deduct it. Receipts, mileage, meals, home office all need to be tracked. Use apps like QuickBooks, Self-Employed, Mileage IQ, or Keeper to track these expenses. Mistake 3, not setting aside money for taxes. Network marketers and investors often don't have taxes withheld. This leads to a painful surprise when you do your taxes. Rule of thumb, set aside 25-30% of your profits unless you have a solid strategy. Taxes are your biggest expense. If you don't learn to reduce them, but with the right moves, they become your biggest advantage too. Now, smart tax strategies for network marketers. Okay, number 1, business deductions you're probably missing. Home office, a portion of your rent, mortgage, utilities, internet. If you need TVs to do things, a lot of this stuff could be written off. Your cell phone, you use it for business. Your out meals with prospect or team members can be 50% deductible. Mileage, travel for events or training is all deductible. Advertising and marketing costs, training, coaching, tools, software, anything, if it helps you grow your business, you probably deduct it. Track everything. Then go to your accountant. Next thing, forming an LLC or S Corp. An LLC gives you limited liability protection and a formal business entity. An S Corp allows you to split income between salary and distributions, saving thousands in self-employment tax. Make sure, again, consult a tax professional, but know these options are powerful as you grow your income. And another thing you have to do is pay yourself strategically. As an S Corp owner, you can pay yourself a reasonable salary. The rest can be taken as owner distributions, which are not subject to self-employment tax. Huge benefit for six-figure earners. This is how top network marketers keep more of what they make without breaking the laws. Smart tax strategies for real estate investors. Depreciation equals paper loss, but real profit. You can depreciate the structure, not the land, of the rental property over anywhere around 27 and a half years, depending on what type of property it is. There's certain aspects of each building can be depreciated over a certain amount of time. But depreciation is what's really key to keeping your taxable stuff down. This creates a paper loss that reduces your taxable income even if your property is profitable. Example, you earn $6,000 a year in cash flow, but depreciation offsets $5,000 of it. You only paid taxes on $1,000, even though you still got the full $6,000. This is one of the biggest legal tax advantages in the U.S., and real estate investors get to use it every single year. Again, mortgage interest, property taxes, and repairs, all deductible against rental incomes. Capital improvements may be depreciated over time, but ordinary repairs are fully deductible. Other deductible items include property management fees, legal and accounting services, travel for property management, education related to real estate investing. This is why it's so much like when you combine network marketing and real estate together, if you get to write off so much in your business if you do it correctly. Then when you get ready to sell your property, use the power of the 1031 exchange. Sell a property. Instead of paying capital gains, reinvest the property into a new property, the profit into a new property. This is called the 1031 exchange. You roll it up over into a like-kind property. Now, in real estate, that like-kind is a wide area. So usually you can get away with a lot of it. What that allows you to do is defer paying taxes and use that equity to build your portfolio. There are strict timelines and rules, though, but you need to contact a 1031 specialist when you get ready to do this. Another one is a cost segregation for tax strategies on real estate. Accelerates depreciation by breaking the property down into components. And this is what I was talking about before on the other depreciations. This can save tens of thousands of taxes on large properties. And this is best for high-level investors with multiple properties. Here's the thing. The IRS wants you to play this game. Here's what most people don't understand. The tax code is not a punishment. It's a roadmap. It's designed to reward people who stimulate the economy, provide housing, and create jobs. Network marketers are rewarded for creating business and generating commerce. Real estate investors are rewarded for providing housing and improving neighborhoods. The IRS is telling you exactly how to reduce your taxes. If you're willing to learn the rules, work with a proactive CPA. Just don't hire someone just to do the file. Hire someone to strategize. Ask them, how can I pay less in taxes legally? Schedule quarterly reviews, not just once a year. All right, this is kind of how I have everything set up, you guys. Have an LLC, taxes and S-Corp for my network marketing business. We have separate LLCs for all of our real estate investing. Now, I'm not talking just one LLC for all our real estate. We have multiple LLCs for our real estate. One property, one LLC. Bookkeeping, tracked by QuickBooks. We have a tax strategist CPA with both MLM and real estate knowledge. I meet quarterly to adjust estimated payments. We track our deductions and plan write-offs. I also keep a separate tax savings account for taxes. We have a business emergency fund and a plan to reinvest tax savings into assets. This structure legally saves me thousands a year, and it keeps me focused on growth and not stress. Here's what you need to remember. Wealthy people don't just make money. They keep it, multiply it, and protect it. Taxes are not your enemy if you play the game smart. I hope you like this. Drop a comment below. Are you currently tracking your business investment expenses? What's one tax strategy from today that you're excited to implement? Remember to hit the subscribe and notification bell. See what next week is. We're going to be breaking down the power of residual income and how to structure your finances for long-term wealth and legacy. It's one of the most important mindsets and money shifts you'll ever make. Remember follow me on social media at the Rocky McKay on Facebook and Instagram. You're not just building income, you're building a future, and smart tax strategy is part of the foundation. See you guys next week.